Away.
Yeah. Hi everyone. I'm delighted you could join us today. My name is Samantha Taylor and I'm the senior analyst at iFi Global. We are very pleased you could join us for the first webcast we have hosted for our private markets risk monitor. The monitor is being launched to promote higher standards of governance across private markets. Given the growing number of problems that we are coming across in various private market investment strategies, we believe that the monitor is well timed to focus the industry's attention on what is going on. Simon Osborne, the CEO of iFi Global, and I will be giving a presentation for approximately 20 to 25 minutes on what we see as the problems that are emerging in private markets at the moment. We hope to have an active Q&A session following that, and we very much encourage your participation in the Q&A. So please do use the Q&A button at the bottom of your screen to raise a point or ask us a question if you would like to do so. We do plan to finish at around quarter to the hour, but I will now hand you over to Simon.
Thank you very much, Samantha, and welcome to you all. We are absolutely delighted, as is usually the case when we do these live webcasts, that we have a fair number of people from a wide variety of different countries. So we're very pleased to see you all. Thank you very much for joining us today. My name is Simon Osborne. I am the CEO of iFi Global. We are, for those of you who don't know us, a research and media house based in the City of London. We have 3 monthly publications and a weekly as well. One of those monthlies is called The Ned, which is a broad now alternative governance publication. It's been around, it's celebrating its 15th birthday this year, and The Ned is always evolving. At the moment, it's very much evolving in the direction of covering risk governance, risk oversight, and to a fair extent also risk management, because there is a lot of stuff to cover in those overlapping and related areas. And we do see, and hence the reason for this discussion today, we do see risk substantially increasing, particularly in private markets on the governance side. So what we're going to do today is cover the 4 points on the screen. I'm going to start by saying why the private markets risk monitor is coming into being. Samantha's going to give examples. We could pick many more, but she's picked a variety of different private market failures that we've noticed that have come along in the recent past, and there's definitely been an increase of those. There's always some happening at any given time, but there is a marked increase in those at the moment. And then we're going to talk about why we think those failures are occurring and the lessons to be learned from them. And finally, we'll end on what can be done to reduce the risk of failure. Okay, so why the private markets risk monitor? In private markets, obviously, it's very different in public markets, but in private markets, partnership structures and other entities that fall in the private markets category, independent oversight has frequently been neglected, which to a large extent is very understandable, because obviously those entities, they're professional investors who have been participating in whatever the vehicle might be, generally speaking, are supposed to be people that know what they're doing, and independent oversight has often not been seen as being particularly necessary for LPs or coming into private market structures, particularly as we've had this fabulous run from whenever 2012 to after the last crash. We started the upswing from then until arguably now. There's been especially on the private market side, the traditional private market side, there's been a very, very, very good run, there hasn't been the need to have that independent oversight in most private market structures. That may be coming back to haunt us now. We'll get onto that in a few minutes' time. Separate and aside from that, we have the one area in private markets which really is growing very quickly, or two areas, sorry, I should say, are what's going on in sustainability, and by that I also mean in renewable energy, as well as the other areas of sustainability like natural capital. They're growing very strongly. But governance, to my concern, I guess, is being, not always, but is often being neglected in a lot of those structures. The other place where it is not as good as it should be is on the digital asset management side, for a whole host of different reasons. Again, we'll touch on that in a few minutes too. So we think at IFI Global stroke our publication, the NED, there is a need for an entity to promote governance standards in private markets and to offer the industry in private markets best practice guidance. And we think if it's going to work, and it's a big if, it might not, but if it is going to work, it's going to require the collaboration of the industry. And again, hence that's the reason why we wish to host this webcast today. So I'm now going to ask Samantha to, before we get into the lessons to be learned from what's going on and what is going on in the broader sense, we're going to have a quick run through of some of the recent private market failures that have been happening at the moment. And I will, before we get into that, in preparation for this discussion today, I thought I would share with you my just arrived at definition of what good and poor governance is, particularly in private markets. Good governance means those responsible for the investment entity, whatever that investment entity may be, whatever the structure may be, those that are responsible for it cannot be blamed or sued, as is going on quite often at the moment, if there is a major performance failure. Because no one can be blamed if the fund or the investment entity fails because of quote unquote legitimate market problems. Poor governance or bad governance means that they can be sued, they can be blamed in those circumstances. And we are seeing, as we track these things, that, as I said, the NED's been going for 15 years now, we see an increase in the litigation and the problems that are occurring. So Samantha, would you like to run us through some of the examples we've got here?
Yes. So unfortunately, we don't have time to provide you with more detail on each and every one of these failings. But I will run you through quickly just a handful of them. I will say that we have regular sections within our publication, the NED, called the Risk Report, and also the Private Markets Risk Monitor, which goes into each and every incident in much more detail. Am I right in saying, Simon, that our publication seems to be adding more pages due to the risk?
Yeah, I think in the March issue of the NED, I think we went, what, 5 or 6 pages of for the new the risk section.
Yes. Yeah. So obviously we're starting with private credit. These 4 failures have occurred within the last 6 to 8 months. And what I want to stress is that whilst there were fraudulent activity in each one, that has unveiled systemic governance failures. And that is the overarching theme here. So starting with MFS, the issue obviously was double pledging. But the wider issue was a shared reliance on independent verification infrastructure that was never wholly independent of MFS. MFS retained full control of capital flow. And I believe Unicus Investor has flagged that this was fully visible within public disclosures. It just wasn't dug into and looked at. As mentioned in our NED publication, there was also an issue with 2 independent directors. I won't go into that, but if you find that interesting, it is in that one. Moving into HPS Investment Partners. Now, this is the private credit arm of BlackRock. This is another instance of failure of verification systems. This time it was due to due diligence and audit failures on collateral invoices. It wasn't done properly. The errors, i.e., the emails, fraudulent emails, did not match up with the purported invoice clients for Brandbat's and Brandbat's aligned companies. So that's quite a big failure. Now we move into Tricolor and First Brands. I'm sure every one of you joining us today are, well versed in this. The two failures obviously occurred within short succession of one another, and you are now seeing cases come up to court, one of which is Western Alliance against Jefferies in relation to the failure. I have also put down investor redemption problems for private credit funds. Within the last 2 months, you are seeing increasing stress for investors, putting through high levels of redemption requests for private credit funds, starting with Blue Owl. The latest is Carlyle. I think we mentioned that in our macro weekly publication. They received requests of 15.7% of the total fund. So private credit is facing a lot of stress, I think. Now, moving into real estate, we have a number of pension funds who have faced private market failures. The first is BVK, which is one of the largest German pension funds. They face failure in relation to several US real estate investments tied to Deutsche Finance America and also a New York-based property developer who had been convicted of fraud previously. Then we keep him with Germany, and we have Hasson Lawyers, which is a relatively small pension fund. They unfortunately had to write down around 58 million euros in losses due to failed US real estate investment. As of last month, I believe their members are increasingly worried about the pension fund's exposure to US real estate investments. Now, moving down into Malawi's pension fund, the Reserve Bank of Malawi has found that the board had, with full knowledge, entered into a real estate acquisition that exposed the fund to significant liquidity risk. And then finally, on this page, we have just general governance failures. Now, IPERS is the Iowa Public Employees Retirement System. Now, there has been a claim by the investment risk officer he alleges that there are significant governance failings, including deliberate deception of the board, subpar risk management practices, and discrepancies in investment reporting. And then finally, we have several claims coming to light in the last few months related to the Employee Retirement Income Security Act for retention of underperforming funds within 401k plans. The latest claim is obviously Bloomberg's 401k, but Stifel Financial, Franklin Templeton, IBM, and Dell are all facing these kinds of lawsuits.
And I should emphasize as we go on into the sustainable failures that I mentioned at the beginning, there's quite a lot in the sustainable space. These are all in just very meaning well within the last year and even within the last 6 months that we had on the previous page. And probably the same on this page, Samantha, aren't they? All very recent things that we have here.
Yes. Yeah, they're all very recent. The most significant failure I think I'm going to mention today is VZB. Now, this is a German Dental Association's pension fund. It was a 2.2 billion euro fund. They have wiped out at least 1.1 billion due to failed private market investments. That includes a California-based recycling firm, a German shrimp farm, a German insurance startup, and a couple of real estate investments also. And as of March, I believe they are suing their former auditor, Forvis Mazars, Apo Bank, which acted as advisor as well as advisor to the B-rated loans that were then issued on the failing companies, as well as 9 former and current committee members for significant governance failings and breach of duty. Then we have the Michigan Employees Retirement System. Now, this failed investment is related to a Hawaiian coffee farm investment, Kona Hills, that has failed, and they are facing a $40 million lawsuit from an agricultural lender due to misstatements as to the health of the investment. And then finally, we have CalPERS and the UN Joint Staff Pension Fund. It's come to light that they have governance failings due to an investment in a Brazilian agricultural company, due to the company itself carrying out deforestation activities, and so forth. Then we have renewable energy investment failures. So Aberdeen City Council has launched action against Hermes Infrastructure on behalf of the North East Scotland Pension Fund. They allege that the manager had failed to identify and manage risks related to the use of baseload power purchase agreements tied to Swedish wind farm assets, which then made up the core portfolio. That exposed the fund to significant downside risk, resulting in the assets devaluation from £104 million in 2019 when the fund ended the investment to being valued at £17 million as of September 2025 when they filed. So quite a significant devaluation occurred. MERS is back on again, but this time in relation to conflict of interest that was found to be spotted in relation to a renewable energy fuels investment with Vedant. The AP funds are on. Again, this is a conflict of interest claim that has just emerged in relation to a failed investment in Northvolt, which was a battery related investment. And then finally, we have Thurrock Pension Fund, who had a significant failed investment into solar farm investments. Do you have anything to say, add on to Thurrock's?
Yeah, well, I was going to add something onto the AP thing as well, but Thurrock is a classic example. And we know the Thurrock story very, very well because we know the individual or his firm and the individual behind who uncovered the problems, which actually very unusually not only was covered in the FT, this is in the UK for those of you outside the UK, but was also covered even in a mid-market newspaper here in this country called the Daily Mail. It was quite a scandal, and the person behind it would say it's a classic example when people invest in sustainability, whether it's in renewables or whether it's in nature or on something like that. Often they let their governance guard down because they think they're quote unquote doing good. But again, unfortunately, we could spend a whole hour talking about the whole Thurrock. Yeah, I could spend several hours talking about it because I know the story probably better than I should do. Perhaps more importantly, this is a time for me to say to everyone, we know of quite a lot of other incidents going on out there which are not good, they're bad, but mostly they get swept under the carpet for very obvious reasons. No one wants, when there's a problem, for it to end up in the press. And it's only the last straw when it does. So we're only at last straw discussions of situations that have arrived in the last few months in these examples we're giving you today. If I publish, first of all, I'd probably get sued left, right, and centre. If I publish everything I knew that was going wrong, we'd have to double the size of the publication. That's an exaggeration, but we'd have to give a lot more space to it. And it's not publishable until it reaches, you know, the often the legal stage, which most people obviously do their level best to avoid. Quickly on the AP thing, which we know AP we did know. I haven't been up to Stockholm for quite a long time, but we've done a number of seminars with AP people there. AP is huge. They're the big public. There's 7 of them in Sweden. They're the big public pension funds. For something like this to be happening at such a large entity, they're conglomerations for for Swedish retirees, and for that to have happened is very interesting. So it can happen to small little pension funds like Thurrock, which is in the county of Essex, and it can happen to much larger pension funds, or even four out of the 7 of the AP funds. So lastly, we'll get off the example in a second. We thought we'd quickly add these, and we'll get on to some of the lessons and some of the broader points. Back to you, Samantha.
Yeah. So notably, there has been a series of lawsuits on the failure for a board to assess climate risk. Now, Cushman and Wakefield is a US case brought by a former employee. They allege that the manager is in breach of its duty for failing to identify and manage climate risks to the core fund, to which the core fund is highly exposed to those climate risks. The fund is also really underperforming its benchmarks, which does not justify the high management fees as well. Then we move into Canada with the Canadian Pension Plan Investment Board. They are being sued by 4 beneficiaries for understating climate risks and having kind of subpar climate risk assessment analysis done. And again, you had a similar type of action against the largest UK pension fund, USS, back in 2022, that got caught up in the courts for quite a long time. And then finally, we have the emergence of nature risks within a director's obligations. So you have the law firm Norton Rose Fulbright saying that there's been 4 legal opinions in the UK, Australia, New Zealand, and Canada, finding that nature risks are material risks, so are within the scope of directors' obligations. Similarly, you have the Commonwealth Climate and Law Initiative. This is the first legal opinion under English law that directors should consider nature-related risk in exercise of their governance and disclosure duties. So it's, we are probably going to see claims against directors if they have been found to mismanage nature-related risks to the detriment of the financial position of the company going forward.
Thank you. So hopefully you get the idea that there's a lot going on out there, and at the risk of repetition, I do want to emphasize the point that if we were sitting here a year ago, certainly definitely 2 years ago or 3 years ago, we wouldn't be able, for over a period of time, say the 6 months before or even the year before, to have come up with as many examples as we have been able to come up today. And as I say, we could have had a few more. And if you, in the issues of the NED that we have been referring to, and there are more examples in there than we've been talking about today. So what are the lessons to be learned from what could be considered in many ways a random set of failures in different circumstances in different parts of the world, in different investments, etc. One of them is, I think this is quite an important lesson, and one of the things that's happened, particularly across private markets, but in a number of particular strategies, there's been a strong trend in favor of LPs investing directly, often in co-investments. There's been a big growth of funds of one, managed accounts, you name it, all sorts of different creative fund investment structuring. I shouldn't say fund structuring. Investment structuring has been going on. It's been grown considerably over the last few years. I do believe that not all LPs, and more importantly, not all LPs advisors who have gone along with this, fully understand exactly what direct exposure they're getting into. I won't go back onto the Thurrock example, but just believe me, please, what Thurrock was investing in and the advisor they had at the time who was advising them to do it, they simply didn't have the experience and the knowledge of investing in the solar farms that they were investing in. And that was besides other problems as well. That was perhaps at the core of it. Samantha was mentioning the Hawaiian coffee farm, weren't you? But we've had examples of, and this is, I think it's very trendy for pension funds to be investing in. I won't name names, and there's no failures alleged yet, but there's been pension funds, quite well-known pension funds, investing in oyster bed farms off the coast of Scotland. There's been all sorts of wacky and fun stuff in nature. As an advisor we know very well said, he's rather cynically, they like doing it because it's tremendously good PR. It looks good on the brochure when they publish their annual results, to show that they're in this, that, and the other in nature. Makes them look very biodiverse and very much with it in terms of what they should be doing. But do they always understand exactly what they're investing in? Clearly, in some cases, in VZB, as Samantha mentioned, in particular, but in other cases, we argue that they don't. I just mentioned already structuring complexity. Definitely, that is at the core, or a large part of it, what happened to MFS. I think there's fraudulent activity there as well, but it would have been much more difficult for that fraudulent activity to have taken place if the structures were more transparent and less opaque than they obviously were. So oversight issues, that's something I've wanted to touch on, Samantha, I think, as well.
Yes, so obviously this is the clearest example I can give you is HPS Investment Partners. The failure to conduct sufficient auditing by Deloitte, and also the accountancy firm CBIZ, meant that the collateral invoices, the discrepancies, i.e. the fake email addresses, the fake web domains, the fake names, were not flagged. If that was flagged, they wouldn't have entered into loan agreements with the fraudulent entities.
Right. And next thing, and this is slightly different, taking a slightly different line to what we have discussed so far, but I think it's well worth raising in the context of the subject of this afternoon's discussion. I especially feel very strongly that risk governance needs to be, not just in private markets, but especially in private markets, much more forward-looking, knowledgeable, and complementary with what the portfolio manager's risk team is doing. And I hear this time and time again. We know of course, we know a lot of independent fund directors, and that side of the board meeting is dealt with normally in 15-20 minutes, if that. And it's really just to accept the portfolio manager's numbers. At a time when we have heightened geopolitical risk around the world, I think it's much more important that there should be some more analysis done on. Obviously, one couldn't forecast the American attack on Iran, but one could have a lot of funds should have had a better idea of what's going on in the geopolitical world that they do. I was at London School of Economics a very long time ago when I was there, economics was going from being a little bit of a broader subject to a highly complex mathematical subject, and you need to now have often not just an A star in maths, but an A star in further maths if you want to study economics at London School of Economics. And the guys who do that are very good at maths, obviously. But if you ask them about what's going on in the world, their knowledge of what's happening in geopolitics is probably less good than the average guy you'd meet down the pub this evening if you wanted to go and have a chat about what's going on in the world. Yet they're making these decisions, and I think it's up to the board, it's up to the people on the oversight side of things to include people on that entity that have a better sense of what's going on in forward-looking overall risk. I mean, there are plenty of firms, especially in Washington, DC, in the States, but there are some over on this side of the pond that do geopolitics as a full-time job. And it wouldn't cost a lot to have a feed-in from them to explain what the risks are in the world. How many fund managers are doing that? I doubt hardly any of them are doing it at all. And that type of information, I think, should be included in the board, and it's basically not. I made this point before, but I'm going to make it again in a slightly different context. I've been around so long now. I remember that period in the run-up to the crash in 2008. Every crash is different, every situation is different. I'm not saying we're about to get another 2008 all over again, but there are some similarities, not with exactly where we were in 2008, but the 2005, 6, 7 period where we noticed, we weren't publishing the NED then, but we were doing other things where we noticed increases in failures that were happening. It's the same old story. People were neglecting the oversight in that lovely period going from the dot-com bubble boom to the early part of the noughties up until the crash. It wasn't needed. Of course, when the crash happened, everyone was then looking around for someone to blame, and the independent directors often did get it in the neck if they were doing anything remotely wrong. So coming back to what we at iFi Global Stroke the NED are trying to do about it, and as I said before, we can't do it all ourselves, but we can maybe take a lead, and we're trying to do that right now in getting the industry better acquainted that we think it currently is in some of the issues that it needs to be acquainted in. So we're looking at doing governance guidance and best practice in 3 areas, and I really emphasize that we want to do this with the industry. And what do I mean by the industry? With independent directors, with service providers, accountants, even lawyers, managers if they want to, but certainly the independent directors, accountants, lawyers, and people like that, in terms of what they think could be done to help contribute towards best practice guidance in these areas. So these are the 3 areas we think we can help with improving things. One is in traditional illiquid alt strategies. Obviously, private equity, real estate, private credit, well established. We all know we've got a problem in private credit right now. But there's been, as Samantha mentioned, with some of the German pension funds, and in other cases as well, there are some issues in real estate. The private equity boom is over, at least for now. And so on. The one area that we've sort of slightly out of left field we put on here with those is infrastructure stroke data centers. We don't see anything wrong, anything happening at all that we know of in traditional infrastructure investing. But data centers, we believe, and we had a call early on this morning with some people in Australia about this, we believe data center risk is seriously underestimated. Very seriously underestimated, and it does fall in sometimes in the infrastructure category, sometimes in the real estate category, and sometimes it's designated as a category of its own. And the NED will be covering that to a much greater extent. There's a whole variety of different ways where we think there is rather urgent need of governance standards, which are really sorely at the current time missing. The sustainable sectors, there are issues there, and to a certain extent, they're also mirrored, if that's the right way of putting it, in the digital asset management space as well. The problem is there just aren't enough people around that know enough about it. Renewables is highly complex. It's a very complex. Actually, natural capital can be very complex too, but especially renewables. A lot of these offshore wind farms or onshore wind and solar things they're giant. There's a series of SPVs, they're highly leveraged investments, and often they require an engineering level knowledge of what's going on in the actual applicability of what's functioning there. So the managers behind them, if they are specialist managers in those areas, tend to pick people they know who have that maybe engineering, scientific background to be on the boards, but they don't necessarily know anything about traditional investment governance. And the people who know something about investment governance don't have the specialist knowledge. That, I think, is both, whether it be in the digital space or in the sustainable space, that's the nub of the problem. But in our 3 streams, these are things we are getting into in the NED, and we'll have educational discussions on those areas. So with part of what we're doing is the Private Markets Risk Forum. and in order to better establish improved governance standards, we're offering the industry the opportunity through our platform to do podcast interviews, particularly with our subscribers, and also we're offering them thought leadership articles in the NED. And if they have something to contribute on the subject matter we've been discussing here this afternoon, we would love to have we'd love to hear from you if you have thoughts on that. And we'd like, as I say, to give you the opportunity of giving your thoughts as to what can be improved in these areas. And then we are looking at doing regular quarterly online forums that everyone can participate in. And to kick this off, we're going to be putting out, now we've got this podcast out of the way, we're going to be sending out to the market a consultation, probably as early as the beginning of next week, with these two questions to everyone that we can think of sending it to. In light of the growing number of failures in private markets, do you think that private markets governance needs to be improved? If the answer is yes, we would like to ask them, please say how you think it could be improved. And that's really all we're going to ask them to do. And hopefully then over the coming months, we'll hopefully gather in a lot of interesting replies and gather that all together and then come back maybe by the beginning of the autumn or before with our thoughts on what the industry has said. So I think at that point, I'm going to stop sharing screen. We do have this, we know there's some people today who couldn't join us live, but we asked them to send us questions anyway. So please now, if you have any questions, please do fire them in. I'm going to ask Samantha to read out the couple of questions we do have, and if you'd like to join us with questions, please do. So,
Yeah.
Samantha.
So the first question is, there has been a big focus in the NED on the governance of digital and sustainable investment funds. Shouldn't they be treated in the same way as other asset classes?
Yeah, well, the person who gave us that, I obviously didn't realize we'd be talking about those areas as much as we did. But no, actually, I don't think so. Is the short answer to that question, because they are new. If they've been around for an awful lot longer than they have been, then the answer might be they should have been treated in the same way. But for the reasons I've just given, just a couple of minutes before you reading out that question, these are very specialist areas. They do mainly fall, if not completely fall, in the private markets, on the private market side of things. But there's been an unusually large number of failures in these emerging asset areas already, and there's no reason for. There's not even it's not even a time when there's been a general market decline. Although renewables hasn't been as successful in terms of performance as many people would have thought or would have expected it would be. The investment is still utterly pouring in, as we cover very regularly in our publication, Sustainable Investment Intelligence. But I do think these there has to be a marriage between, for those people on the governance oversight side of things, there has to be a marriage between the specialist knowledge one needs to be useful in those areas in any type of discussion, with an understanding of how a collective investment scheme of some shape or another works, and there just aren't enough people around that have both those skills at the same time. Ideally, a board should have people from engineering, scientific backgrounds, and then a traditional NED, a traditional fund industry NED. Why not? But they would if they're going to only have one independent director, they're going to have the one with the specialist knowledge rather than the industry knowledge. And I think that's a mistake, because if you're a pension fund or any other form of LP, you want to see people on the board that understand how the process works, I think. So that's my best answer to that question, I think. And we haven't touched, sorry, last thing, we haven't had time today. We have done recently in the last 6 months, but we haven't done any proper digital in asset management discussions, and we should do that, because tokenization is really taking off now in lots of different areas. We did a white paper recently on stable coins, and then of course there's crypto as well. And there's all manner of potential issues there, but we won't get into today. Sorry.
Yes. So we have another question. For UK-based portfolio managers and boards governing them, there is this concept that the FCA now focuses on which is consumer duty. And so for private investments still need to cover this lens and which may help them in terms of counteracting misinformation to LPs as well as better governance. I've definitely seen this as an area where boards are pushing on to improve governance. Any thoughts?
Sorry, that's I didn't. Can you read that out again? That's someone obviously must have just sent that in. So,
Yeah.
so sorry, I didn't catch all of that. So apologies.
For UK-based portfolio managers and boards governing them, there is this concept that the FCA now focuses on, which is consumer duty. And so for private investments, they still need to cover this lens, and that
Sorry,
may
they still
help
need
them.
to cover what? This
Do you want to read it from there? Oh, consumer duty lens.
Right.
There we
go. I'm not with it. We promised we'd finish at quarter to the hour. I maybe whoever asked that question will try and give them an email answer to it, because I think that is a huge subject and I probably can't give it justice in the seconds we've got remaining. I apologize for that.
It's very interesting though.
Yeah, it's an interesting challenge, and that's something we should try and get back to the person who has sent that in at another time.
So our final question is, what is the most common cause of problems in private market investments aside from poor performance?
That's also a very good question. I would say, well, obviously it is poor performance, but as I said at the beginning when I was doing my definition of good governance, the problems only arise when even if you're not responsible for it, when the performance is poor. I would say it's simply lack of knowledge of the investment, especially without the risk of returning to the same theme again and again and again in the emerging asset areas, but it could be it's in all sorts of other areas. If you go back to what happened in 2008, 2009, and so often the directors were just utterly clueless on what was really going on. They were just there to sign the papers and collect their fees and move on. That, I think, is just lack of knowledge of what was really going on in the investment structure. Now we have much more complicated and complex investment structures. That's another problem that's occurred, but just really staying on top of the whole thing so you can stick your finger. What's that famous expression about being a director? Noses in, fingers out. So you can stick your nose in, you can get the right smell that you need and keep your fingers away so you don't have to interfere. But not enough people necessarily have the knowledge to be able to do that, I think.
Yeah, I think that's fair.
Now, we promised to end at 1:45, and I think we're absolutely on the money there, hopefully. So shall we, unless we've got any other questions, we should try and maybe bring it to an end. Well, thank you very much, all of you who joined us today. Really pleased to see that pretty much everyone who joined is still with us at the end, which is always a good sign. And hopefully see you the next time. A lot of this stuff will be covered in, as Samantha said, in a great deal more detail in the NED, and we'll be getting back in touch with those questions I mentioned at the end. So have a good morning or afternoon or evening, depending on where you are in the world, and hopefully see you the next time. Bye-bye.
Thank you. Bye-bye.